Okay traders, welcome back to the LiquidFX YouTube channel. Here we have the GBP USD or the GU chart in front of us, pound against the US dollar, and we're going to be going over very specific concepts that relate to the ICT power of 3, otherwise known as the accumulation, manipulation and distribution. But before we go down to the 15-minute time frame and dissect the power of 3, it's important to understand what this higher time frame or this 4-hour narrative is depicting. So if we begin here with the 4-hour time frame, again, if you've watched any of my videos, you understand that the 4 basic pillars to understanding directional bias on the higher time frames come from understanding our market structure, understanding what dealing range we are in, understanding whether we are in premium or discount, so that's the PD arrays, and then from there identifying the correct fair value gaps and hence the points of interest, right? So this is what we're going to be going over first. So the first thing to understand just by looking at this chart is that we have bearish structure. So if I quickly mark out the structural highs and lows, what we understand is we have a structural high over here marked out in orange, and then we see price giving us a higher low. Then we saw a higher high, we saw a retracement giving a higher low. Then we saw a higher high up here before ultimately the market gave us a bearish break of structure. So the bearish break of structure is just over here. So from here we have a bearish structural dealing range to work with. So we understand just by accomplishing the main objectives at the start. So we have our market structure to begin with, then after that we have our dealing range. So far we've essentially covered points 1 and 2. Okay, because what we have is we have our bearish structure, which is shown by the bearish break of structure to the left, and now we have a structural high and a structural low to work with, right? So we have a structural high over here, and we have a structural low down here. The third thing we want to consider when it comes to understanding market direction is the premium and discount arrays. Where are the premium and discount arrays and how can we use them in our trading? So the premium and discount arrays essentially is identified by projecting the Fibonacci tool from that swing high down to that swing low, just like this. So these are the main Fibonacci settings I use. You want to project the Fibonacci from the swing high down to the swing low. And after this, we want to identify our fair value gaps. So we want to be looking for premium fair value gaps as we are bearish. Okay, so if we zoom into the price action, what we want to do is we want to understand where the points of interest are, where the POIs are. Okay, so we understand we're above that 50% level. So this line here represents the 50% level. Anything above that is indeed a premium. And so from here, once we have our premium, we need to then understand where the fair value gaps are. So what we have a massive fair value gap just over here. Very, very large fair value gap just over here. So let's label that in blue. And once we've identified that fair value gap, this gives rise to this particular candle over here. So it's the last candle before the inefficiency. So this gives us our 4-hour point of interest or our 4-hour POI. So let's label that 4-hour POI. Okay. If we drag this over to the right of the screen, what we've seen here is price mitigate this POI before heading lower. And this is the reason for this week's, from Tuesday the 28th down to Wednesday Tuesday the 28th to Wednesday the 29th. This is the overall bearish activity that we've seen, right? Just from understanding where the POIs are, you can position yourself to be taking sells when you know you need to be taking sells, okay? So what we have over here is we have price reacting off a very valid POI. And a question I often get from my students is, what makes a POI? What are the main factors to a POI? What are the 3 rules? Well, the 3 rules to a POI are very simple. The POI must break structure. So it must be part of a structural leg that breaks the previous low in this case. So this is the previous structural low down here. Of course, we saw a break of structure to the downside. And this is what validates this POI over here. So the first rule is that we must see a break of structure on any time frame. You want to see the POI break something, whether it's major structure, minor structure, a supply or demand zone. It has to break something, right? Typically swing structure on the 4-hour time frame. The next thing we want to identify is whether it's left a fair value gap or not, okay? So a fair value gap is what I've highlighted here in blue. So this here is the blue zone, the blue box is a fair value gap. And that fair value gap represents an inefficiency which the market will look to rebalance and reject from at some point. So the second rule is that we need to have a fair value gap. And the third rule, like I said at the start, is that a bearish POI must be priced in the premium. So a premium POI is essentially a bearish POI or a supply zone that we could see a bearish reaction from, hence what we are seeing now. So we're now going to go down to the 15-minute time frame and analyze a bearish power of three or a bearish accumulation, manipulation, and distribution. But the most important thing I want you to understand so far in the video is that you must have the three rules of a POI in check. It must break structure, it must leave a fair value gap, and it must most importantly be priced in the premium if you're looking for a swing sell, which is what we're going to be going over now. So let's head down to the 15-minute time frame. So the 15-minute time frame shows how price is driven into the POI and is then hence reacted off it. Okay, so from here, what we understand, let's quickly break down our model. So what we have is we have three steps to the power of three. So the power of three consists of price giving us an accumulation or a range. Okay, so you want to ask yourself as a trader, what is the purpose of a range? Why does the market produce a range? In this case, we want to be looking at an Asian range. Okay, so first you want to analyze the word range, and then you want to analyze the word Asian, right? What does the Asian session range actually give us? The Asian session range, the main job of it is to do two things, right? We understand it's a low volume time of day. Low volume time of day, because you understand this is the GBP USD. So in the Asian session, the pound and the USD will not be as active in the markets compared to the Australian pairs or the yen pairs, right? So it's a low volume time of day, and therefore because of that, linking on to the first point, it builds liquidity, hence why I put the dollar sign there. It builds liquidity. So as a trader, as traders and analysts, what we're looking at is we're looking at two specific points with the Asian range. What we're looking for is the Asian range high, and we're also looking for the Asian range low. So these are the two most important bits when it comes to analyzing the overall market structure. Sorry, the overall accumulation, manipulation, and distribution as a whole. Okay, so what we have over here is we have the Asian range from Tuesday the 28th of May, right? We have the Asian range over here. So this here is essentially our accumulation. Okay, now from here you want to understand this is actually a two-phase manipulation model, something I've gone through in the channel previously. What do we mean by a two-phase manipulation model? So a two-phase manipulation model is quite simple. We're looking for price to sweep the Asian range low and then the Asian range high. So let's quickly go back to our diagram and break this down. We have the Asian high with the red line on top and the Asian range low with the red line at the bottom. So what we're looking for the market to do is we're looking for the market to head down and sweep the Asian range low before then sweeping the Asian range high. And then from here, we look for our breaker structure to the downside. Okay, so this is what we mean by two-phase manipulation model, right? We have our accumulation and we have two phases of manipulation. We have manipulation down here, which I'm going to label in yellow, and we have manipulation up here. And the higher up manipulation, or the second manipulation, is what we call the Judas swing. This is another word for the Judas swing or the turtle soup, or simply we call it in the community a second phase manipulation model. So what is the purpose of this move over here, right? So this here is a trap for early sellers. Early sellers are enticed in this region over here. I've been in this region many times, even recently sometimes. It does happen to me where you get enticed early in the markets prior to price tapping into a higher time frame POI or a higher time frame PDRA level. That's exactly what's happened over here. So this here is a trap. This is a trap for early sellers, right? So early sellers trapped here. And we're going to be going over an example of this. Okay, early sellers are trapped here, and then they all of them get swept out over here, and this is what gives us our ICT Judas swing, right? Which is a manipulation or a buy-side manipulation, right? This is buy-side manipulation. So we understand from here, buyers are enticed, right? Buyers are trapped, and the early sellers are trapped or manipulated out of the market. This is one of the most powerful and regularly occurring manipulation models in the markets, right? So let's now go to the live price action and see what happened over here. Again, this is not a trade that I took personally, but this is more of a price action review. So what we have over here in the London session, we saw a tear down of price, giving us the manipulation over here. This is sell side manipulation or enticement of early sellers, right? Sellers are trapped within this region over here. Now, if we head up into the London and New York session, we see a rally up coming into this POI. This is not an accident, right? This is how the markets work. This is how the markets operate. What we see is we see the markets giving the ICT Judas swing. This is an ICT Judas swing. And one question I often get is, what actually makes an ICT Judas swing, right? What are the rules behind an ICT Judas swing? Okay, so this is a Judas swing. So when we look at a Judas swing itself, right, the Judas swing has a couple of things you want to characterize from it. It must break structure. Typically, the very high probability Judas swings, or typically the Judas swings that I trade personally, they are all bearish ones are all above the Asian range high. Of course, if it's a bullish one, it'll be below the Asian range high. But this is a bearish case study or bearish price action review. And so the Judah swing itself must occur above the Asian range high. So it must break structure and it must be above the Asian range high. Now, the third thing, which I should have actually mentioned at the start, is that it must occur in either the London or the New York session, right? So timing is very important because we understand the whole of ICT, or a very large chunk of ICT, the underlaying, the groundwork to ICT is essentially focused on time, right? It's time-based price action, time-based liquidity sweeps, time-based breaks of structure, time-based fair value gaps, time-based everything, right? The Judah swing must occur in the London or the New York session. So wherever you are around the world, calibrate your times to Eastern Standard Time. So you're looking for a Judah swing from either 12 to 3 p.m. UK time. So that will be, I believe, 7 p.m. to 10 a.m. New York time, Eastern Standard Time. So wherever you are around the world, understand that time plays a very, very critical factor to the Judah swing. The other thing to a Judah swing you must understand is that it must break structure, right? It must break structure to the downside in this case. So from here, we understand, looking at the way that I mark out my structure, once we've identified the Judah swing, right, you need to understand the Judah swing wasn't validated until we saw price break structure. And the break of structure, the true break of structure, was actually down here, right? Was actually down here. So let's go back to our model now. What we're looking for is we're looking for price to break structure to the downside. And in this model, this is where the break of structure is. So once we've seen a break of structure, right, we started with an accumulation. We've had a two-phase manipulation. And after accumulation and manipulation, the next part of the power of 3 becomes the distribution. So what do we mean by a distribution? Well, a distribution is a fancy way of saying find an order block and trade off it. That's all it means, right? It's keying off a fair value gap, okay? And this gives rise to an order block, right? An order block. An order block is essentially a fair value gap which we need to key off, right? Keying off a fair value gap is key, and that's exactly how this trade was depicted, right? So essentially, once you've identified a fair value gap, you want to sell off the fair value gap, have your stop loss above the Judah swing, just to be safe and stay in the trade. And that's essentially how the model works. An overview, a high-level overview of the model works like this: accumulation, manipulation, and identify your order block, and then trade the distribution, right? So where did this occur in the live markets, right? So let's quickly clear up the charts. We'll get rid of this. As traders, it's important to understand an order block is essentially you're keying off a fair value gap, and the fair value gap must break structure. So what do we mean by that? Now that we've had a break of structure or a shift of market structure over here, MSS, market structure shift, from here now you need to understand, or you need to identify, where are the fair value gaps? Well, there's a fair value gap just over here in price. It's a bit hard to see from here, but I'm going to zoom in. For those who can't see, this is the fair value gap over here. So we had a very subtle fair value gap over here, which I'm going to label in blue. A fair value gap is a fair value gap. It doesn't matter whether it's a pip or whether it's 100 pips, right? A fair value gap is a fair value gap, okay? And this is essentially what we key off, right? This is now our order block itself. So this is now the order block itself. It's the candle before the inefficiency. So another question I often get within the community is, Liquid FX, how do I find the order block? Which is the order block? Why did you depict this as the order block? Why did you depict that as the order block? An order block is very simply the last candle before the fair value gap. So find the fair value gap, and it's the last candle before, right? Write this in your notes, get it in your heads. Last candle before, very, very important. When you see a fair value gap, identify the last candle before. That is your order block candle, and just simply draw the box. That's all you have to do. Don't overcomplicate it, right? Now from here, of course, going into Wednesday, this is now the distribution phase, catching the distribution phase like this. So again, what you could have done, well done for those who caught this trade. I didn't personally, but what we had over here, again, you want to have your stop loss. I would have it just above the Judah swing just to be safe. A 30 pip stop loss isn't a lot. And now from here, once you've identified the direction, right, understand that this whole trade was tapping off this 4-hour POI, right? This is our 4-hour POI. So the entire trade was built off the higher time frame narrative, which is very important. If you don't have a higher time frame narrative, you are trading blind. If you don't have a higher time frame narrative, it's like driving with no direction. You've got to have a direction, and the direction comes from the higher time frame narrative. But once you understand the higher time frame narrative, catching distributions like this for a 1 to 2 or 1 to 3, it's not difficult to do, because you need to then come down on the lower time frames and understand you can either have a 2-phase or a 1-phase manipulation model. This here is one of our 2-phase manipulation models, right? Understanding we have an accumulation with the Asian range, we have a distribution after the manipulation, after a 2-phase manipulation, sweeping the Asian range low, and the Asian range high. This is how we essentially trade at Liquid FX, right? Keying off the correct fair value gap and identifying a distribution to potentially trade off. Okay, so if you like this video, give it a like and thumbs up, and I look forward to seeing all of you in the next one. Drop in the comments also what other videos you'd like me to see. Which markets would you like me to analyze? Do you want me to go into futures and crypto a little bit more? Do you want me to go into some more forex pairs? Do you want me to analyze specific things you don't understand? Market structure shifts, liquidity. I'm open to discuss it all. Drop your comments in the comment section below, and I look forward to catching all of you in the next one.